Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Liz Clayman. The markets, you saw this, rallying to fresh highs this week as investors swoon over President Trump's regulatory rollbacks. Billions of dollars in Obama-era federal regulations have already been slashed by the new administration and by Republicans in Congress.
And one of the biggest regulatory changes could be to Dodd-Frank, the law that places major regulations all over the financial industry. The former Federal Deposit Insurance Corporation Chair, Sheila Bair, joining us now. Sheila, great to see you. Thanks for joining us. I think that you're in favor of simplifying Dodd-Frank, but you think the industry desperately needs to continue to have this regulation. Explain to us.
Yeah, absolutely. So I do think there are areas that could be simplified. There's a lot of complexity and bureaucracy on Dodd-Frank that I think has actually helped the big banks and hurt the regional banks and the smaller banks. So simplification, I think, could be helpful, as long as that's not a ruse for weakening. And I think the key area where they do not want to weaken, where they actually still need to strengthen, is on capital requirements. That's really important. And I fear that all this, ebullience about bank share prices is really more anticipating that capital requirements are going to be reduced, which will release capital to distribute to shareholders, and that's really not going to do much to help the economy, and certainly not going to do much to help resiliency.
Sheila, did I hear you correct saying that you think that Dodd-Frank has actually benefited the big banks?
I think the unnecessary complexity has benefited the big banks. I absolutely do. You look at how complex some of these liquidity rules are, the Volcker rule. Yeah, I mean, large banks with very large compliance offices and teams of lawyers can handle it, and regional banks and smaller banks cannot. It disproportionately impacts them. So yes, I do think simplification could ease reg burden on the smaller banks, which were not drivers of the crisis to begin with, and at the same time make these rules more effective. You know, complex rules are very, very hard to enforce. They're hard for examiners, they're hard for boards and managers to oversee. So yes, we could have a good deal of simplification around Dodd-Frank.
Yeah, it sounds like college entrance students should be looking into going into regulation because of Dodd-Frank.
Well,
because these banks have had to hire so many people, including the little guys, which has been very onerous. Look, Dodd-Frank, as you know, is a bear of a law. 2,300 pages, some 400 separate regulations and rules, some of which haven't even been read yet. Let's just quickly...
It's not finished.
Donald Trump has already started to try and trim where he is allowed. There was one area that he signed. He rolled back the anti-corruption measure of Dodd-Frank that required public companies that extract oil and natural gas from having to, I guess, disclose annual reports and payments when they do business with foreign governments. That's a very small percentage. What bigger chunk would you say, beyond requiring the smaller banks to do less when it comes to regulations, what else would you remove from Dodd-Frank to help the markets and to help stocks? Right.
Well, I think since this is stress testing, I think, again, a lot of the apparatus around stress testing is really geared more towards the larger banks. We've expanded the net too broadly in terms of who needs to be stress tested and the rigor and complexity around those stress tests. That's certainly one area I would look at. I think simplifying liquidity rules would be helpful. It's much more important to get strong buffers of capital liquidity, which means the ability of a bank to access funding in times of stress. During the crisis, that was really a function of the market perception that they were insolvent. They didn't have enough capital. So prioritizing capital rules, strengthening those, and simplifying some of these other areas, I think, would make sense. And Jeb Hensarling has proposed an approach along those lines, as has Tom Honig. I don't agree with everything in Jeb's plan, because I think on what we call OLA, Title II of Dodd-Frank, which is designed to prevent bailouts, he wants to repeal that. So I very much disagree with that. But the concept that with much stronger capital you can ease some of these other complex rules, I think, has merit, especially for the smaller, simpler institutions, and other strong regulators like Tom Honig have also advanced that approach. And if I were Mr. Trump and wanting to ease unnecessary regulatory burden in a smart way, I would be looking at that approach.
Sheila, let's talk about the stock market in the week that was. Clearly the market is not listening to anything other than the fact that not just Wall Street regulation, but regulation across the economy has really hurt this economy. It's kind of amazing to me as a long-term investor and somebody who's watched the markets for 30 years now, that is the market correct that once all of these regulatory burdens are unleashed, that we're going to see this great economic growth, or is the market ahead of itself?
Yeah. Well, the market's ahead of itself. I do think there's a lot to be done in terms of regulatory simplification, making regulations more effective through simplification and reducing the costs at the same time. But I think probably more important in terms of his agenda to boost the economy would be meaningful and smart tax reform and infrastructure spending, which we need, which would get costs of doing business down. There are a lot of additional frictions and costs in doing business in the U.S. because of our crumbling infrastructure, and that would create jobs to begin with.
You know,
so
on that
I think
point,
there are pieces that...
On that point of tax reform, you saw the markets act like Pavlov's dogs every time President Trump mentioned any kind of tax reform, pretty much just bold strokes. But what within that? You know, he's talked about getting rid of certain, well, you'd have to figure, charitable deductions. Who knows? The mortgage deduction. People still have a lot of questions. What must this tax reform look like to really spur the markets?
Well, and that's been an overarching concern with this new administration. Did they really come into this administration with clarity of purpose and a plan that could get majority support in both houses? So there are a lot of questions, but I do think even if you do tax reform in a revenue-neutral way, just by simplifying the rules, getting rid of a lot of these special loopholes and deductions, lowering the top bracket or lowering the brackets for everyone, you can stimulate the economy just by doing that without having a tax reform plan that would lose revenue. So, as a traditional, conservative Republican and fiscally conservative, I hope he goes in that direction and doesn't blow a hole in the budget with a lot of more tax giveaways. That's not tax reform. But there's not a lot of clarity about what he has in mind. But you can certainly stimulate the economy just by cleaning out the tax code and lowering the brackets. So we did it in 1986 when I was working in the Senate. It had tremendously beneficial economic benefits, and I hope he'll look back at what was going on with the Reagan administration and putting his own plan together.
All right, Sheila, we need to talk to you about one of the other possible crises ahead, and that's a student debt crisis. So stay right there. Don't go anywhere. When we're back, we'll address that. Wall Street Week, we'll be right back.